No, sir. Yes, yes.
Okay, good, good, good. So if you go to the bank, it will take more time, plus the interest rate going to be high as well, because, or maybe the bank may refuse you because I don't have any credit history with the bank, or maybe my business is new, I don't have my performance history with me as well, right? So company must accrue interest expense and interest payable at the end of the period, right? So if period coincides, or if you write it down, the notes payable for 10,000 and 100 is your interest. So at the end, how much you will pay? 10,000 and 100 yuan, right? So let's talk about its treatment. We have illustration here. So just pause the video here and read this. Yes, read this illustration, and then we'll try to solve it together. So for those who are watching our online lectures, so I'm reading for them as well. The following entries cover the purchase of inventory costing 8,000, accrual of interest expense, and payment of 10% short-term notes payable due in 1 year. So remember, I also explained over there earlier that this 10% means annual. Remember this one, annual. So after 1 year, if you use this 8,000 for whole 1 year, then you will pay 10%. If not, then we will try to find out partial payments. Okay. So on January 1st, you purchase inventory and you write it down, notes payable. What would be the entry?
Account payable, right?
But remember, you write it down, notes payable. So this is not an account payable. This would be short-term notes payable. Your inventory increase, so that is going to be increased by notes payable, because you draw notes, you write it down, notes payable, and you give them some kind of a, your business letterhead, write it down, some agreement. So that notes payable is going to be your liability. So answer would be inventory to short-term notes payable. If this question is silent, then of course inventory to account payable. Right, Jordan?
Right, I got it. I did this. It's true, right?
Okay. Now, what happened here? Now the company fiscal year ends each September, which is September 30, right? At the end of the company must accrue interest expense for 10% for the January as well. So company's accounting period is expiring at September 30. You write it down the notes payable on January 1st. For 1 year, it means you will retire that notes payable on December, right? But since September is your closing date, so you will close down. So how much interest is now accrued? 9 months, right? Would you pay nine months interest rate? No, you will pay the whole notes payable along the interest on December, not on September. But since we need to follow account revenue and expense recognition, so we will write it down the expense on the same period. So 9 months expense, interest expense belongs to this area, this fiscal year, September to September. So what would be the entry? Interest expense happened, but did you pay interest expense to cash? Did you pay the cash? No. You will create liability. So answer would be interest expense to interest payable on 30th of September, not on 30th of December. On 30th of December, there's going to be cash payment, right? So where we got this 600, so 8,000 multiplied by 10%, we use for 9 months. Answer would be 600. Right? Okay.
No, why is it 9/12?
Because we use this notes payable, we use this money 8,000 for 9 months. There we go. Let me go back to the slide. Right? So we issued on January 1st, 2014, but our accounting cycle ends on September 30. So how many time or for how much time we use the money? January, February, March, April, May, June, July, August, September. 9 months. Right, Misha?
Right. Okay.
Okay. Okay, now on 30th of December or January 1st, 2015, we will pay our liabilities. Means notes payable, we will retire it. So that 8,000 we will pay back plus the interest, right? And we already expense 600 interest expense, right? And that already gone to the income statement. But rest of the time, how much money we used? So September to October, October to November, November to December, 3 months. So this 8,000 multiplied by 10%, multiplied by 3 by 12. How much? 200. Right? But should we record the expense? Yes, 200 going to be expense. We already recorded the expense payable, 600, right? We'll pay back that as well. And how much cash we pay? 8,800. 800 is the interest, 8,000 is the amount. So entry would be notes payable retired, 8,000, right? Interest payable, the liability we created last fiscal year. Interest expense 200, this period interest expense, and to cash, total cash gone out from our pocket, 8,800. Understand, guys? So this is the partial payments. If this is 1 year, then we don't need to create liability. This would be 800. But since we are retiring this notes payable in 2 different accounting period, financial period or accounting period, so we would be using expense recognition principles. Okay, guys? Any question? Okay. Let's move forward. Okay, if you understand this notes payable, please answer this concept checker. For those who are watching online, so I'm just going to recite it. A notes payable may require the borrower to accrue interest expense and interest payable at the end of the accounting period. True, false?
True.
Jordan, Min, Arone, Sipade,
Yes, sir.
David, David, Chloe, Min, Junpyo. True, false?
True.
1 second.
True. True, sir. True. That's according to me, it's true.
David, did you got through?
I'm still thinking. 1 second.
Okay. It's gonna be too hot. I'm sweating. What do you think so, David?
I'm sure about the second part, interest payable at the end of the accounting period, but I'm not sure about the first one.
A notes payable may require the borrower to accrue interest, of course. It's not like that I issue the notes payable and at the end of every month I am going to hand over you interest payments for 1 year. No, I would be paying you the whole liability at once at the end of the period. So of course, interest is going to be accrued monthly basis. And when the time comes, you pay back the original money plus the interest together. It means the person to whom we owe the money, he cannot claim the interest during the period, right? He will wait until
Yes.
the period is expired and then he will receive the original money plus the interest. Okay, guys? So this is true.
Oh, that makes sense. The interest, yeah.
Okay?
I
Let's move.
saw it as a different thing, not as a difference though, or an interest though. That's why.
Okay, now you understand?
Yes, sir. I understand now.
Okay, okay. Okay, and then one of the current liabilities, sales tax payable. Okay, so what is sales tax? So the seller sells the goods and he collects taxes on the sales and at the end submit those taxes to the government. So it means he collect regularly the taxes as well and submit at the end to the government account. Here we go. So sales taxes are levied on retail sales. So these are collected from the customers and remitted to the state. So